So there's two angles that are very important here. One is how do brokers feel they're being selected this year versus last year, and the second is internally how are they spending their time. Now, brokers, last year when we asked brokers how they differentiate themselves, there was a very wide view and it wasn't necessarily in line with the buy side's view of how they were choosing brokers. And what we've seen in the last 12 months is a very clear alignment around two basic priorities: cost and client service. So for example, brokers last year felt that cost was about the fourth most important consideration in how they were chosen. This year it's number one, much more in line with what the buy side view, and client service is number two. So there's a very, very strong alignment now on the basics. Now internally, how are people spending their time within banks and brokers? The most important point is survival. Ultimately, more than 50% of resources now, for the first time, are being spent on dealing with regulation and dealing with cost cutting. So last year that was 44%, now it's more than 50% that's being spent purely on survival. So 36% on dealing with new regulation and the remainder on cost cutting, which is obviously a significant spend when you think that less than 50% of every dollar that's now being earned is able to be spent on client strategy, product innovation and new development. So the obvious casualties are the fact that the organisations that we're speaking to aren't necessarily focused on growth, they're really focused on how do we stay where we are today. And that's most apparent amongst the investment banks, who are spending over 45% of their time and resources purely on regulation. So that leaves obviously very little for looking after your clients and preparing for the next 5 years of growth. Liquidity is the other side of the coin from the regulatory and the cost-cutting challenge. This year we've really seen a kind of pincer movement, if you like, in terms of what brokers and banks are suffering from. Banks, from a liquidity perspective, 25% of the people we spoke to have said that they see a significant increase in the last 12 months in the amount of capital they need to run their business today. So this is really driven by clearinghouses and regulators asking for more capital, more collateral, not to do more business, but just to do the same amount of business as they are doing today. What's really worrying is that over 15% also believe that next year that's going to continue rising at a fairly alarming rate. So there's a real challenge, not only from an operational perspective in terms of having less money to spend on your customers, but you've got a significant liquidity constraint that's going to draw up time and resources, and it's only going to get worse. So the key point of the survey is obviously to work out the role of outsourcing as a solution to the challenges around cost cutting, regulation and liquidity. And historically we've always found that brokers and banks have had a fairly conservative view around outsourcing, taking quite an emotional view in terms of the key reasons not to being around branding, visibility, control, fairly abstract things. What we found this year is that actually people are a lot less scared of outsourcing than ever before. There's been a significant fall in the people who cite branding, control and visibility as a reason why not to outsource. And so there's much more of a shift this year on why outsource, how to outsource. So it's become quantitative, not qualitative. Now the role of outsourcing in a practical context is significantly changing as well. Over 75% of the people we spoke to cited outsourcing as being an answer to regulation and to liquidity, so they're key challenges, but not necessarily as a way of improving on what they already do today in terms of business as usual. So it's very much the consistent theme is how to protect themselves against what's coming down the track, rather than necessarily how they work today. So on the one hand, you have more pressures this year than ever before, and on the other hand, you have less reasons why not to outsource than ever before. And not surprisingly, that has translated into a significant growth in outsourcing in Asia this year. So 36% of brokers and banks have outsourced their back office operations or part of their post-trade operations this year, which is a significant growth on the last 5 years consistently that we've seen. Most importantly, the growth has been in every single post-trade activity, from confirmations all the way through to tax. But the single biggest area of growth is in cash equities clearing, where we've seen 16% growth year on year in terms of people actually outsourcing that activity in the core Asian markets in Hong Kong and Singapore primarily. So every year we ask the buy side and the sell side some of the same questions in the survey, with a view to benchmarking and understanding whether the sell side have really understood their clients properly. And this year the buy side have really underlined increasing conservatism around what can be outsourced and what's not. So fundamentally that comes down to a distinction between how you manage your balance sheet and how you manage your people. The buy side increasingly this year have said, look, we don't necessarily like you outsourcing your people in the middle and the back office. So we want to speak to the same people, we want consistent levels of service, but we're quite happy for you to outsource your clearing membership, your counterparty exposure. So we're happy to see you manage your balance sheet more effectively, but we still want to speak to the same people every day. And that's a very fundamental shift, and it's a growing trend versus last year. So we've seen a huge growth in the interest in third-party clearing this year, and specifically the number of people that plan to outsource it in the next 12 months. And that's really driven by two measures. The first is the perceived value that people get from all of their post-trade activities. Now last year, every activity more or less was deemed to be a little bit more costly than it was valuable or complex. And so there was a desire to outsource more. What's interesting is that this year, there's much more of a perception that what can be saved has been saved. So really, actually, the perception of value versus cost is actually very positive now across the board, with the sole exception of cash equities clearing. And that's largely, I think, because of the liquidity constraints that come with self-clearing. So on the first hand, basically, people don't see a value in cash equities clearing, and therefore they're happy to see it outsourced. When we drilled in and we asked people, okay, specifically, what do you see as the takeaways from third-party clearing? One of the key points was that it addresses liquidity, so it protects people against spiraling liquidity constraints, both in terms of regulatory capital and clearinghouse collateral. Second of all, it's an excellent path to new entry, so there's a very strong answer from people who are investing in new asset classes in 2013 that third-party clearing is the default way to enter a new market. And also internally, C-level managers have shown an overwhelming amount of support for third-party clearing versus their operational and their treasury colleagues who have always been much more conservative. So there are many reasons externally why it's a good point, and now internally there's a strong body of support to say this is actually something we want to do. So this is the first time that we've actually segregated North Asia from Southeast Asian responses. And it's very interesting to see the distinction between the two. In North Asia, where the background is one of heavier regulatory capital requirements, most people have been quite used to outsourcing for many years, with the prime consideration being how to optimize your FRR, your regulatory capital in Hong Kong primarily. Now in Southeast Asia, where that requirement is less or more flexible, people have really focused in the last 12 months on the clearinghouse collateral. So significant changes going on, driven by IOSCO, more collateral required by every clearing member. People have actually turned to outsourcing in a much more substantial way this year than ever before in Southeast Asia. So the basic trend is that regulatory capital in Hong Kong has been around for a while, or a long time, and has driven outsourcing for many years. Southeast Asia has seen a shock event in the last 12 months in terms of clearinghouse collateral and is reacting very strongly, over 60% now looking to outsource in Southeast Asia as a reaction to that change.